Wells Fargo has agreed to pay $2.09 billion to settle a government probe into the bank's creation of mortgages riddled with flaws, which the U.S. Department of Justice said contributed to the financial crisis that helped unleash the Great Recession, the government announced Wednesday. Abuses in the mortgage-backed securities industry led to a financial crisis that devastated millions of Americans, acting U.S. Attorney for the Northern District of California Alex Zay said in a prepared release. Wells Fargo's problems arose from the bank's decision in 2005 to launch an initiative to double its production of subprime and Alt-A loans, mortgages that later were found to be flawed and risky, the government attorney said. With these types of mortgages, a loan approval would be based in part on using a protocol known as stated income, whereby the borrowers were obliged to simply state their income without being required to document that the income stated in the loan application was accurate. Today's agreement holds Wells Fargo responsible for originating and selling tens of thousands of loans that were packaged into securities and subsequently defaulted, Zay said. Under the terms of the agreement, Wells Fargo, without admitting liability, will pay a civil monetary penalty to resolve all civil claims available to the U.S. government, the bank said in a statement posted on its website. We are pleased to put behind us these legacy issues regarding claims related to residential mortgage-backed securities activities that occurred more than a decade ago. Wells Fargo's chief executive officer Tim Sloan said in a prepared release. San Francisco-based Wells Fargo noted that a number of other U.S.-based banks had previously reached separate settlements with the Justice Department to resolve similar problems with residential mortgage-backed securities. Importantly, there were no claims that individual customers were harmed as a result of the alleged conduct, the bank said in its statement regarding the settlement. At one point, Wells Fargo launched a series of internal tests in an attempt to determine whether the honor system of stated income, provided without proof by borrowers, was accurate. But the tests pointed to a wide variance between the claims of borrowers and the reality. The results of Wells Fargo's 4506T testing were disclosed in internal monthly reports, which were widely distributed among Wells Fargo employees. One Wells Fargo employee in risk management observed that the test results were astounding, according to the Justice Department announcement. The bank's risk management employee went on to say that, despite the disturbing test results, Wells Fargo decided to expand the stated income loan programs in all business lines. The bank also didn't reveal the flaws with the risky mortgages, the Justice Department stated. Despite its knowledge that a substantial portion of its stated income loans contained misstated income, Wells Fargo failed to disclose this information, government prosecutors stated. Wells Fargo sold at least 73,539 stated income loans that were included in residential mortgage-backed securities between 2005 to 2007, and nearly half of those loans have defaulted, resulting in billions of dollars in losses to investors.